Welcome back, and it's time for us to welcome a very special guest on this coverage of Budget 2018. Manish Chokhani, Director at Enam Holdings, joins us on the show now. Hi Manish, good afternoon, and thanks a lot for joining us on a day like this. Good afternoon to you. First up, I just want to get your reaction. Is it a thumbs up to Union Budget 2018 or no?
Well, you know, at its very heart, it's really a political document. So, it's delivered what the politics needed. From a individual perspective, naturally, I pay more taxes, so I can't be too happy with that. But I don't think it was unexpected. And the reality in our country is, it's like Mr. Kishore Biani, he calls India 1, India 2, and India 3. So India 1 naturally has to pay a lot more to help India 2 and then also India 3.
The big question is whether India 1 has really made enough money over last few years to keep paying for India 2 and India 3, Mr. Chokhani, because FM is also worried about the outbound capital investment, and I don't know what options he is looking at.
Sure. No, if you're asking honestly from a structural perspective, I don't think we are doing the right things long term, and it's not to do with this budget or with this government, but generically as a country. And maybe it's an issue with our politics that it doesn't allow us to do so. The reality of life, and I just want to take 5 minutes to explain it properly, is that the government collections all put together are, say, 9% of our GDP. So let's say they collect 9 rupees, and out of the 9 rupees, they have a deficit of 3.5, which is a staggering amount if you were to treat it as a company. And that 3.5 is met by borrowings. And coincidentally, that 3.5 also happens to be the interest payment of the government of India, which means you're basically borrowing money to pay interest. And what therefore that leaves you with every year is you end up spending from the union budget about 1% of GDP on infrastructure creation. Because you'll spend about 3% or 4% on defense and salaries of government staff. You'll spend 3% on your social schemes. You'll spend another, 1.5% on your subsidies and stuff like that. So it doesn't leave you with any room. And every year you hear of a crisis on the fiscal side, and we end up discussing decimal points of GDP. And at the end of it, you don't end up getting either the roads you deserve, or the ports you deserve, or the rural roads you deserve, or indeed, for all the crying about the agrarian crisis, the reality is you will not solve agrarian crisis by doling out some money here and there or giving them cheap power or cheap fertilizer. The reality is the economics of the business of agriculture globally have shrunk because it's a commodity business, and the only way out of it is to have value addition by putting in food processing plants and stuff like that. So unless deep structural changes are made to the economy, this incrementalism of running it a little more efficiently or targeting one section or the other section at the expense of someone else, will get us to the 7-8%, but it's nowhere close to potential of what the economy has. And the magic bullet for that, in my opinion, coming back to that whole 3.5% of GDP being spent on interest, it stems from the fact that the government in the 1950s built up public sector assets because there was no capital in the country, and they were supposed to be the temples of modern India. But now I ask, if at some certain time in life we had a BSNL which was worth 100,000 crores, and now I don't think it's worth even a fraction of that. Or you had an Air India which was worth a lot of money when it was the only airline, and now it's probably a negative 40,000, which is what we discussed. And you contrast that with what happened when they sold off Maruti or they sold off Hindustan Zinc, and the whole efficiency argument and scale argument which comes. I don't understand what is the great social cause which is being served by holding on to Steel Authority of India or NALCO or BHEL, when you can sell those assets which give you nothing except a dividend, which is a meager amount, because anyway you collect taxes on their profit. So if you can monetize that $300, $400, $500 billion which you are sitting on, it drops your interest outgo, it drops interest rates in the economy, it sparks an investment revival, and it gives you money to go and spend on creating infrastructure and also for creating soft skills, which is the need of the hour to create jobs. So if you have to discuss the budget in the contours of what is being presented, well done. But in the context of what needs to be done, my sense is we're completely missing the plot in our country.
Manish, hi, Neeraj here as well. What about what the budget did to address or did not do to address one key point that a lot of people wanted, which is bring down the bond yields? If anything, they've inched up. Now you could argue that the borrowing number was okay, maybe the fisc miss here and there led to it, but there is a crying need. Corporate after corporate is talking about how there is a 50 bips increase in cost for them as a result of what's happened over the last 3 months. Was there a trick or two that could have been done but which was missed out?
But this is what I say, that if our expenditure is going to be pegged at 13% of GDP because your expenditure side is so inflexible, like I said, there's salaries, there's defense, there's subsidies, there's social schemes, that's never going to go away. The only way out, and you aren't going to increase your taxes, because how much more will you take away from that 2% of India which basically pays taxes, is you have to monetize your assets. And if you have a tiny country like Saudi Arabia, which is I think 1/5 or 1/6 of our size, able to talk of $1 trillion valuation of Saudi Aramco, and probably they will raise $100 or $200 billion from that. In the context of that, we are talking of a 12, 13, $14 billion disinvestment target in a government which is presumably sitting on $1 trillion of assets itself. If they don't sell assets, they will not be able to get rates down, because that doesn't give them the money to pay down the debt and lower the market borrowing and preempt it away from the private sector. I think the debate in India, and especially from media and informed citizens, should be about this whole thing of why on earth is this government sitting on all these businesses and trying to prove that it can run a business better, when it's been proven year after year after year that if you contrast a Hindustan Zinc performance with a Steel Authority or an Alco, I think the answer is very clear. You compare the performance of Air India versus Indigo and Jet Airways, I think the answer is very clear. It just foxes me that we keep discussing, fiscal deficit 3.2 or 3.5, whereas the picture should be revenue deficit, first of all, should be 0. We have no business spending more than we earn. And then we're taking away from the crying need to put infrastructure on the ground. And now not just the hard infra, we need to invest in the soft infra as well. And clearly the resources are there. It's just a question of mindset. And at 7.5%, I don't think anyone's putting up capacity in India.
I think this was one of the best years, right? We have already got 92,000 crore, and the target is to reach to 1 lakh crore. But are you happy the way the targets are getting achieved?
Well, I mean, if you sell HPCL to ONGC, it's really left pocket to right pocket. Look, the reality is, I don't think the ministers are in any doubt, and they say so themselves, that 10 years from now, India will be driving, for example, electric vehicles. What happens to a refinery which then is producing transportation fuels? It's clear that these refineries will have to be converted more and more towards producing plastics and petrochemicals, and no longer that need for refined product. If that is the case, then again we go and argue that we want cleaner, greener environment. And for sure 10 years from now what's going to be the state of Coal India. For sure what's going to be the state of BHEL. For sure what's going to be the state of NTPC, if the world has to move more and more towards solar and renewables. These assets are going to decay in the next 10 years. So instead of transferring a refinery to ONGC, if there was, like in the case of SR Oil, some external investors happy to come and hold that asset for you, sell it. Because really, like I'm pointing out, I think currently there's $350 billion at current market value, I could be wrong, but only be higher, it won't be less, of public sector undertakings held by Government of India, on which I don't think they make a dividend of more than $3.5 billion at best, if that. If you monetize that $350 billion over the next 5 years or 6 years, you have $50 billion a year coming to you. That $50 billion can be reinvested into creating infrastructure for not just cities, but for the farms. You can be doing it all over the country. And with that kind of equity infusion, imagine with the leverage potential that you have on that whole $1 trillion infrastructure need of India being the hour, when is it ever going to get fulfilled? So I think the answer is there and it's obvious, but I don't know what is the political will lacking to get this done.
Manish, well, we'll keep debating with regard to long-term capital gains tax, but tell us, how does this change the dynamics of investing in India, considering it's come after 14 years? Do you think investors are going to take a lot of time to digest this now?
No, I think, look, investors are practical people. The market's a discounting mechanism, and there are hundreds of people who may be invested, some who may not be. It raises your hurdle rate naturally, because earlier you were making post-tax the whole return. Now you will make that much lower by paying that tax. But the reality is, if your company is going to perform and the company stock is going to go up, are you not going to buy it because you have to pay a tax at the end? I don't think that's the answer. So for Indian investors, I don't think we have a choice. You pay it and live with it, and it's the right of the government to ask whatever you want from your citizen to pay tax. From a global investor, the country has to get increasingly more attractive and receptive. And in that context, I don't know among developing world how we stand, because we like to compare ourselves with the developed world when it comes to taxes and compliances, forgetting that we lack the infrastructure and yet the market size and opportunity which those countries have already achieved, and therefore they are charging those levels of taxes. So somewhere this will reconcile, I hope. We live in hope. So investors, as you know, are optimistic people. Having said all of above, am I fully invested? Yes, I am. Will I remain fully invested? Yes, I will. Will I continue to buy Indian stocks? Yes, I will. Because it is still the best asset class in our country. And the only path to real sustained wealth creation in our country is to own a business. So I stay where I am.
Well, I think we'll cut this bite in particular, Manish, and play it out on social. This will have a fair bit of resonance with a lot of people, I'm sure. A couple of quick things. With regards to revenue, were you okay with the kind of numbers? I mean, we were just looking at how the number of cesses that each individual investor or otherwise has to pay just keeps on going up, whereas cesses were meant to be stopgap arrangements in order to fulfill one need or the other. And just coupled with that, the GST revenue estimates per month for the next year, I understand that yes, GST revenues by and large will move up, but the assumptions northwards of 60,000 crores is what I thought it was there on an average per month. Realistic, you think, or ambitious?
No, I don't think on the revenue side I have a lot of quabbles. I think there is buoyancy coming in the country generally, because last year we of course had only 11 months of GST revenue, and earlier we had that the big shock to the system through demonetization. So the country's base is starting off at a low level, and certainly because of the global recovery, conditions are better. Like already you see oil prices are up, metal prices are up, and that itself will start giving a boost to earnings and therefore to taxation. So I don't have a quarrel with the revenue number. And again, if you miss few decimal points here and there in the context of GDP, they're ballpark going to end up with 9% or thereabouts as kind of their revenue number of GDP. They'll ballpark end up with kind of 1% as their proceeds coming from disinvestment and telecom spectrum and stuff like that. Ballpark, they're at 10% of GDP is the net revenue of the center. I mean, you can swing a couple of basis points here or there, it doesn't really move the needle. And frankly, we keep discussing 3.2 or 3.5 as a percentage of GDP, which is the real misnomer. It should be discussed as a loss of 3.5 on a revenue base of 10. So it's a 30-35% loss which you're running every year, and that loss has to be plugged, and you cannot run it by borrowing money to pay interest. I just keep coming back to the same thing. The government has no business sitting on all these assets which are decaying with time, and if they don't monetize it today, you'll be in the sorry situation of how we are now selling loss-making companies as the strategic disinvestment list put out, or indeed Air India, and that can't be the test case. We should be selling assets when they are well priced at their prime. Like they haven't managed to sell the residual stake of Hindustan Zinc for the last 13-14 years. It's the best time to monetize that asset. The government sitting through Sutti on ITC. Why on earth should the government be sitting on ITC through the Sutti stake? So there's lots of low-hanging fruit out there. I think it's a question of application of mind and some dedicated effort. The way they got GST done was brilliant. The way we have got the NCLT and the insolvency code done is brilliant. The way we have actually got Aadhaar and DBT to work is brilliant. So there's lots of good work which has done, but I think the big miss of this $500 to $1 trillion of assets sitting there not producing a return is something that I guess the Prime Minister has to really get focused on this now and just go after it. Because this is what will give him the headroom to go and create capacity in the villages and in tier 2 towns of India. Because we aren't ready otherwise to manage the growth.
Yeah, I think the test case here would be BSNL, where there were a lot of takers and there won't be any now if they want to really sell it. That's a kind of wealth destruction we have seen. But other than this budget, how do you really look at the markets now? Looking at the global outlook that you have, global equity and commodity outlook, and the interest rate outlook, where do you really see markets 12 months from now?
So look, the world is clearly in recovery mode. The world equity markets and commodity markets are in exuberance zone. Money is still relatively cheap, though it's going to get tighter and tighter. The scenario has been of a melt up in global markets, and we've just followed suit with other emerging markets. So nothing really unique has happened in India in that context. Globally, mid cap, small cap, EM kind of stocks have all had a fantastic rally. I think we'd like to believe we're at the beginning of a bull run in India, but the reality is we're probably closer to the end of that kind of easy money led bull run globally. And there will be challenges if interest rates actually go up more than what markets are currently discounting. And if indeed the growth in the world and commodity prices rise the way they are, and US now seems to be at full employment as well, it's possible you start seeing inflation and then the market has not priced that in. So you could be in a spot of bother, and the markets are by no means cheap. I don't think anyone can argue that here. So we're currently in a Goldilocks period where there's growth and there's liquidity, and no one wants to get off the bus because there's nowhere else to go. So from that perspective, well, from a markets perspective, if you make a 10% higher number this year, I think people will be quite happy. Although now, of course, you would have given it away in capital gains tax, but on balance, I don't think like 2017, which was a 45% return year, is going to repeat in a hurry. I hope that answers your question.
Well, I think it would. But Manish, sorry, if I can just throw in a follow-up there, because I heard you speak about inflation. And my numbers may be a bit here and there compared to yours, but 2002 to 2007, if we look at it, or 2003 to 2007, showed us that even with a higher inflation and a sustainably higher inflation, growth can take place. We've kind of seen a return of growth if at least Q3 numbers are to be believed. Do you think both can happen at the same time for India in calendar year 18, possibly leading up to calendar year 19 as well?
No, so Nikunj, there is a band of inflation which is good inflation. Like even in the US, they say that if you go up to a certain band of inflation and interest rates don't rise above 4%, that is a good scenario for those markets. Similarly, in India, I think if you get to, say, a 4% kind of inflation number, I don't know why our real interest rates are actually so high in India. But if you stay within that band, of course, you need some inflation for people to have expectations of an upwards, sloping yield curve as well as for their product prices. So at a certain level, it's okay. But if you're going to now start pushing inflation into the system, the way the last government did with their NREGA program, and then on their MSP, which they start putting in, it just led to agri-inflation. I don't think that's the solution. And frankly, what we call a shortage and therefore a rise in profits in industry is nothing but inflation in profits because there is no adequate capacity built up. So for instance, in steel, if you had not put an MIP, there would have been enough capacity either in India, or you could have been importing whatever you wanted from China where there's surplus capacity. But because that capacity doesn't exist, or there's an artificial cap put on that supply, it leads to a profit expansion. And we are reaching in the Indian markets that period where capacities will get utilized better over the next 12-18 months, which should give you a big profit expansion. But beyond that, it will be treated as kind of supply side inflation because there will not be enough supply there. So what may be good for equity markets in the last phase will become bad for the regulator in the sense of trying to cool down inflation and then trying to get interest rates to go in the other direction as well. So if you think of cycles, you sort of the equity markets precede, then profits follow, and then inflation and interest rates follow. So if you stay with that cycle, you'll understand what I'm talking about.
Yeah, for sure. Anyways, Manish, such a pleasure having you. Always good. Thanks so much more so on a budget day. Thanks so much for joining us and speaking to us at Bloomberg Quint.
Thanks for having me.
you.